Hello, I'm Steve Griffiths. I'm the Sales and Product Director at The Mortgage Lender. So in case you haven't heard of us, we're a first charge residential and buy-to-let lender. We don't call it specialist lending, we call it real life lending. And today we're going to take a look at how that real life approach is needed more than ever to support your self-employed customers. So we're going to take a look at why we do need to focus on the self-employed market and the things that make a difference in meeting their borrowing objectives. In particular, how the current COVID environment and what advisors need to understand about how those additional risks are underwritten. There's a lot of talk at the moment around how lenders, providers, etc. Need to adapt their propositions to allow for the current situation. And I'm sure we'll see a lot of that happening in the coming months as people get to grips with what the new customer needs are. But I think we also have to remember that this is happening now. You'll be getting cases on your desk that are self-employed applicants that maybe are facing some challenges within their mortgage funding. So it's really important to understand what your lenders can do to help out those customers that are happening right now. So why is the self-employed market important? One thing we've seen from the self-employed market, that it's grown consistently over the last few years. It's now around 15% of the labour market. So that's about 1 in 7 of your customers are now self-employed. That figure is actually much higher if you're based in a larger city. And what we often see, especially after times of recession, is that self-employed market continues to grow. So you have situations where customers may have had a break in employment, redundancy, for instance, and make that decision to go it alone. It could be that, unfortunately, as part of the economic pressures that businesses face, that some of those businesses fail and their owners have to start again under a new structure and build their business again. But what we have seen is that the self-employed market really handles itself against the adversity that's been thrown at it over the recent decades, particularly around the financial crisis in 2007, 2008. Also, we hear a lot about the gig economy over the last few years and how the younger generation of borrowers maybe aren't tied to traditional income streams. They have multiple income streams. And as you can see, advertising, one of the key areas of growth in that recent market, alongside some of those other creative industries and technology that maybe need that type of flexible resource, that's resulted ultimately in creating a new wave of workers looking for themselves. So a good solid base, recent growth. But as you can also see, as part of the research that we've done into the self-employed market, there is a lot of customer dissatisfaction. In fact, in our research, 7 out of 10 customers said that they felt that the mortgage industry discriminated against the self-employed. So we're going to take a look at a few of those issues into the access from self-employed customers to their mortgages. Generally, I think that the self-employed tend to lead the way when there is bad news about access to mortgage funds. Although you do need to keep things in perspective, there is still generally good availability in the market for customers that have consistent levels of income over a reasonable period of time, in stable industries, with a good credit score, within average income multiples, and a nice normal property with a good deposit. But actually, that's quite a big list. And I'm sure you all see customers that don't tick all of those boxes. So you can understand why customers, in some cases advisors, see those challenges outweighing the benefits of going through with the transaction. We can see lower loan to values offered for the self-employed, increased scrutiny of the applications, which lead to more documentation requests, longer underwriting times because there's more documentation, and ultimately may end up with a smaller loan size than the customer actually needs for their requirements. As I said, 71% of self-employed customers told us that they felt they were discriminated against because of their income type. A further 27% said that they would be put off even applying for a mortgage because they were self-employed. So 7 out of 10 unfairly treated, over a quarter feeling that they wouldn't even apply. And this was pre-COVID. So we're doing some additional research over the next few weeks, which we'll be coming back to tell you about in the spring. But this is something that a lot of customers feel that it's a tough gig to get a mortgage if you're a self-employed customer. So we need to start challenging those perceptions, and that changes now really with understanding how specialist lending can provide real life lending solutions for those customers. So let's have a look at the ingredients for the Great British Affordability Bake-Off. Assuming we can reassure our customers that there is a way forward for complex self-employed scenarios, our next challenge is affordability, which we've chosen to demonstrate through the medium of cake. So seeing as we can't all have a cake with you and a coffee at the break or at lunch, we decided to demonstrate it this way. Let's have a look at some of those ingredients that are in there. So yeah, standard things: debt to income ratio, credit profile and score, normal things like what's the maximum term for the customer because of their age, how many dependents, etc., and other things like maybe pension contributions that are a bit more relevant within the self-employed schemes. The obvious one there that I haven't talked about is income multiples. I think as an industry, we're a little bit obsessed with income multiples. I know I am. It's the first thing I tend to look at if I'm looking at a competitor's products. What's their income multiples? We get about 200 to 300 calls a day within our telephone BDM team. And generally, there will be a question in those calls about what's your income multiple. I think we have to remember that an income multiple is just a cap. It just tells that's the maximum that the customer can borrow. There's lots of other elements within an affordability model, and all lenders' models are different, that actually dictate what the customer's borrowing outcome is going to be. So if you're looking at expenditure, typically most lenders take a similar approach to expenditure affordability. We tend to use ONS statistics that look at average households, different types of household, different areas in the country, etc. And there are some exceptions, so things like big expenditures like big pension contributions or maybe school fees can have a big impact on expenditure, but it's broadly linear in terms of what makes a difference. The main driver for affordability is what allowable income the lender will take. And for self-employed applicants, as we know, there are lots of variations of that particular ingredient. What income is going on the top of the calculator? Is it last year's income? Is it an average? Is it profit before tax, after tax, salary, dividends, salary and dividends, all of the above? So there's lots of different combinations. And actually, when you look at a particular scenario, so we're taking a very kind of fictional, straightforward case study here of a self-employed applicant, and assuming they are hitting generally the maximum that lenders would take. It's not a given that a self-employed applicant would get 4.5 loan to income, but assuming that it goes to that maximum level, looking at a fairly successful business that's turning good turnover, taking a fairly standard salary, and taking dividends out for their for own personal income. And if we look at the three basic models, we have three very different outcomes. So a typical, more likely high street scenario of taking average salary and dividend over a couple of years or so gives this customer a loan size to 47,500. If you're looking at something a bit more specialist, where maybe looking at the most recent year's figures, but basing it rather than on salary and dividend, taking into account the salary and profit after tax, that's going to push that borrowability up to 297,000. But actually, if you look at the most recent year's figures and actually taking profit before tax, you can see that that's a much bigger number, 360,000. No secret that that's the model that we use for our affordability. But it's probably something that we see contributes towards some of that lack of understanding within self-employed customers and why they feel slightly aggrieved about the situation. If we look back at those customers that probably feel that they can't make an application, there was actually a bigger number in that research for customers that actually had a fair number of employees, so something between 5 and 9 employees, the actual number in that research was 34% wouldn't have applied for a mortgage. And that's quite ironic when you think about it. In these kind of scenarios, if you're looking at the documents that a customer provides for their income, all of those employees can walk in with a pay slip or a P60, and we look at their gross income and say, okay, that's your gross income. Before tax, that's what's going in the calculator. We generally don't tend to do that in the mortgage industry for the self-employed, but we think as long as you've got experienced underwriters, a good attitude to risk, and a team that can actually understand accounts, spot any danger signs, etc., there's not actually that additional risk in taking the higher amount in the most recent profit before tax. Generally, you'll have a lot of other indicators that are around the application that will support taking that figure. So just an example of some of the differences that you can see. So moving on to our current situation and the self-employed lending in 2021, and particularly the impact of COVID and the extra challenges that self-employed customers have faced over recent months in terms of just reduced profits from pressure on trading, having to deal with explaining government support for their businesses, maybe picking up some credit impairments as far as cash flow goes that have impacted on their personal income and expenditure. The first thing I'd say is that I think advisors have done a brilliant job in getting to grips very quickly with a lot of new challenges that came out of nowhere. I'm sure nobody was sitting there last year around this time thinking, I must go and spend some time understanding how my lenders approach bounce back loans, because they didn't even exist and we haven't even thought about why we might need them. So I think actually in terms of providing advice and staying close to customers in some challenging times, the intermediary community has done a great job. So let's look at taking those into account. How do we actually underwrite that going forward? How do we take those issues seen on a regular basis and turn that into hopefully a positive outcome for the right type of customers that are in a position to proceed with their mortgage application? Okay, so taking a look at how we underwrite some of these scenarios, bearing in mind that businesses will have been impacted by COVID. So first thing to look at is the income. Is the income that's being declared from the most recent documents, i.e. their accounts or their self-assessment documents, does that support the borrowing that the customer needs? So at the moment, we're kind of in the eye of the storm. We're not seeing really a lot of COVID impacted accounts. That's typically because obviously we're running a set period behind. Typically what we're looking at the moment is December 2019 accounting periods closing, perhaps April 2020. So we're not actually seeing a lot of COVID impact on that because probably most of that happened after that period. Assuming that the customer has a similar amount of turnover reflected in their bank statements for the current quarter, we don't see that there's any reason not to use that most recent year's accounting period as the customer's income. So quite simply, even if there has been a bit of a dip, if that business has recovered and is now trading in line with the previous declared income and the customer is still happy to declare that as their income, then we're happy to use that to support affordability. Moving on, we're looking at some other things like government support, government loans, grants, etc. And in general, what you have to look at here is the government support forming any part of the declared income or being used as deposit funds? And as long as the answer is no to both of those things, then generally it's okay. What we need to understand is the income that is going through that business or shown as as a balance is actually derived from the business activities. It's not a problem if there's some additional funding there that's been from utilising government support. However, we do need the income to actually support that. So it's not a problem that they've had it, as long as they're not using it to pay their effectively their income, their salary, and as long as they're not using it or expecting to use it for any part of their deposit. In general, we're taking the view that business owners took government support either because they needed it at the time, they didn't need it, but they took it anyway, just to be prudent or just in case. And I think we're seeing quite a lot of cases there that, yes, it's been used, but it doesn't necessarily reflect a reduction in income. It's quite easy to spot those businesses where they're still relying on that for effectively paying wages, drawing income, etc. We will start to see more accounts in the coming months where there is a reduction in income as trading periods. We start to hit sort of September year ends, etc. Then we'll start to see some of those more rapidly affected businesses. Now, that's when some of those differences in terms of how much we can take from the customer's income really have a big impact on the customer's borrowing ability. So that difference between maybe a most recent year, as most specialist lenders would take, maybe being able to take profit before tax, can make a big difference in filling the gap in some of that lost income. Finally, just really looking at some other issues that may have happened because of that cash flow, or again, just because of government support offered, particularly mortgage payment deferrals. We don't call them holiday, they are payment deferrals, they don't go anywhere else, they are a payment deferral. We're quite happy to look at those and understand that they are not arrears, they're not missed payments, and as long as the customers have repaid and started repaying their mortgage again, then that's the biggest demonstration of affordability and intent to actually be able to repay their mortgage funds. Slightly different situation with unsecured arrears. So where we probably will see more of these type of cases where customers maybe have had a squeeze on their income, and that's reflected in how they've been able to make their payments. So they've stopped paying, they've had some arrears, maybe they've restarted their payments, but they're still showing in an arrears position on the credit search. That will impact on credit scores. It will impact sometimes on even specialist decisions. But what we're looking for is to say, do you know what, if you're carrying that arrears position forward, as long as it's not getting worse, as long as you're making those payments and you've recommenced them, then that's really, for us, it's the sign that excuse me, the danger has passed, things have moved on, and we're kind of back to normal. So that's our approach to hopefully giving you a bit more of an idea about how we're looking at self-employed, how we can add some value to your business by ultimately meeting more of your self-employed customers' expectations. Throughout all of this, one vital component is the relationship you have with your lenders. And all specialist lenders will say the same. Talk to your BDMs, talk to your telephone BDM teams. They have the time and they are more than willing to, demonstrate specific areas of their criteria. Shouldn't just be just a general catch up every now and again. I challenge you to say, spend some time, speak to your specialist lenders, get them on a Zoom call to demonstrate their affordability calculator, talk through some of the situations we've just talked through there, because as I said earlier in the presentation, this is happening now. We're very much there to help you and your customers. So please feel free to reach out at any point in the process, whether it's a specific case or just getting a bit closer to being more comfortable with what you might have to deal with a bit more often these days in terms of self-employed challenges. So thanks very much for your time, and we'll move on to some questions.